everyone here. And really, really beautiful day here in the Arctic blast of Michigan. Sorry about that there, a little bit of a technical problem. But thank you all for joining us. Got a little bit of a unique update. We did this last year and had a lot of response to it, so I wanted to do this again. A business and economic update. And so I'm Charlie McQueen, President of McQueen Financial Advisors. Appreciate you joining me today. We're going to have a nice talk. I'm very fortunate to have an incredible team of people I work with that lead our three main areas of activity. We have our investment advisory, our asset liability management, our interest rate risk area, including CECL. We also have our valuation services and advisory services. So super excited to have these three groups and all of our support teams with me. It helps me talk about stuff appropriately and really provide you guys some great information. Throughout the webinar today, if you have any questions, please click on the Q&A icon in the bottom or top of your screen, depending on which version you have, and type it in. We'll answer the questions along the way or at the end, whichever is appropriate at the time. Today's webinar, as with all of our webinars, is being recorded and will be shared on our YouTube channel. Please reach out to your McQueen Financial Advisor. Your advisor will be able to send you a copy of this if you'd like, and appreciate you spending some time with us today. So with that, today is an interesting conversation. Today's kicks off the conversation about leadership. Leadership is always an easy thing to say, but a hard thing to do. Leadership becomes very important when we get into a time of change and a time of uncertainty. Leadership, when things are simple and unchanged, continues, and it's not a big deal. You just follow the path. But when there's lots of uncertainty, leadership really comes through, and it's something that's key and important. Today, we're coming across unprecedented issues, wars, super big changes to interest rates, uncertainty, political activities, budget deficits that are record-breaking, and record levels of bankruptcies in corporations. We're seeing all sorts of different things happening all at once, and a stock market that's reaching new highs. So things are definitely different than what we've seen in the past and unique. So with that, leadership to me is where you bring really smart people together. You always want a team of people, and that's what makes me excited when I come to work every day. I work with a team of people that are extremely intelligent, and you want to have a group of people that are really intelligent around you. And what you want to do is develop a conversation. Discuss situations. One, for example, today is discussing rising deposit rates. Deposit rates are rising very, very quickly. What are we doing to work through this? What are our options? Let's explore our options. Let's put different ideas out there. Let's go with some hypotheses and see which ones work and which ones don't. Reading a book the other day, and it was a great conversation about a company that had an A and a B development team, and they put them both off to do the exact same thing, kept them separate, fully knowing that one was going to fail because they were going to choose the other one. And so leadership's about trying different things, looking for different things, discussing, and then finding solutions. When finding solutions, it's not always the easiest, but that's then what the hard part of leadership is, making a decision. Sometimes the best decision you can make is make a decision. It may be the wrong decision, and it's okay to make a wrong decision. And when you make a wrong decision, you then change and go back. Again, another part of leadership is knowing when you've made a mistake, admitting you made a mistake, and moving on. Every business makes mistakes. Every leader makes lots of mistakes. But we try not to make the same mistakes twice is one of the key components. That making a decision is extremely important. It's not always a unanimous decision. A lot of the times it's not a unanimous decision. A lot of the times it's a 5-4, 3-2 vote, and that's okay. We want dissension opinions, but once we've made the decision, we all walk out of the room, the boardroom, the leadership room, whatever the meeting may be, as one voice. And so it's really important that we get to making a decision. We go as one voice. Does that mean we're done forever? No, that means we have to go back and check and continue to evaluate our decision. We all know the definition of insanity is doing the same thing over and over again, expecting a different result. Well, leadership is about making decisions, and then if you're wrong, changing course. Or if things change course. It doesn't necessarily have to be wrong. We want to make sure that we're all committed to going in the same direction. So today, margin is one of the most difficult things. And the business we're in here as a financial institution is a margin business. Everything we do is about making a spread between our yield on assets, loans and investments, and our cost of funds, core deposits, CDs, borrowings, etc. we need to make sure that that margin is good at all times. Today, we are running into significant margin issues with the cost of funds skyrocketing across the board. It's always important to take a step back and remember the Fed did raise interest rates 525 basis points in about 18 months. We have not been in this quick of a rate increase since going actually back to the 80s. I mean, just amazing to think about what happened. And now the deposit costs are slowly catching up. So that's causing some pain today. On top of that, there's lots of inflation. I know the inflation headline numbers seem low at times, or lower than where they've been. They're down, but there is lots of inflation. There's lots of inflation in different areas. But inflation is hitting all of us. And I've been fortunate enough to attend a number of clients' meetings, board meetings this past month, or during this month of January. And a lot of the conversations that people keep having is not only the budgeting for the institution, but also the board members talking about their companies and how they're struggling with their budgeting there. So definitely a lot of things going on here. Fixed costs are going up. Inflation is causing a lot of negative impacts. So we have a lot of pressure on earnings, and we're going to see 2024 is going to be a year of a lot of pressure on earnings. Also, on top of all this, non-interest income is definitely struggling. We used to get things from mortgage income, investment area, different things. We're definitely seeing those incomes come down. And so that is putting even more pressure on institutions. So if we think about what happens, we have this ebb and flow, this constant change. We think about this loans. We have a volume of loans that come on the books, and we have a yield of loans. Earlier this year, we saw last year we saw some substantial volume in loans. Actually, there was an article in the credit union space, record high loan to deposit ratio as of the end of November in the credit union space, and as of year end. Amazing. What does that mean? Liquidity is struggling, and we continue to see liquidity struggle. Deposits, what's happening? Well, we're going to go through a number of charts in a bit here, but money supply is going out the door. So we think about this. We have money going out the door from deposits. We're bringing in more expensive deposits. We have some loans coming on the books. One of the most important things I want you to take from this presentation is make sure you continue to put loans on your books. If you stop putting loans in your books, you stop increasing that yield on assets. And it's extremely important today that we continue to increase our yield on assets up higher and higher as that cost of funds continues to reset up and up. So we've got to work with this ebb and flow that takes place. So I mentioned deposits. Deposits running at the door has been a big issue with liquidity. We'll go through some charts in a little bit, but money supply is shrinking. It's been shrinking now. Actually, the biggest drop in money supply ever recorded has happened over the past year. Why is that? Well, the Federal Reserve is doing quantitative tightening. They're pulling money out of the system. We're talking about them switching to quantitative easing or neutral here. Depends on what you listen to, who you pay attention to, but that's looking like we're going to see a change, and we're going to talk quite a bit about that in a couple of slides. But CDs are growing. People are saving differently. Money is going to money market accounts. Money is going to brokerage firms and money market accounts. Those dollars going out are chasing yields right now. I get it. I want to get the highest yield I can in my money market account. I want that also. The hardest thing for us this next year, 2024, while it's continuing to put really good loans in the books, the second thing to take away from this is we really need to make sure that we're doing everything in our power to retain our non-maturity deposits and attract new non-maturity deposits. Super easy for me sitting here at my desk to say, go get non-maturity deposits and retain them. Absolutely extremely hard. Making sure you're looking at pricing structure, you're looking at how we're doing tier pricing in money market accounts. Make sure we're looking at how we're getting out to the market, how we're asking for deposits, requiring deposits with loans. All those activities really need to be carefully looked at. And at the same time, utilizing the bank term fund. It's a great spot right now. We can all go and borrow from it, make a 60 basis point spread between our borrowing costs and the yield that we can put in overnight funds at the Fed. It's a great thing to utilize. That's going to be coming down to 1 year left here in March. I believe it's March 11th. There's 1 year left on that. So while that is still here and it's still an option, it's going to come to an end in about 14 months. But it's a great spot to help. That's really the third thing, is thinking about that utilization. Now, if we think big picture management, we really want to make sure that we're thinking through management of our balance sheet. How are we managing our balance sheet? What are we doing correctly? And it's really the basics. And that is why we need to make good loans at good yields, bring in good core deposits at the lowest possible cost, utilize borrowings and other tools to fill in the difference. But we really need to make sure that we're making profitable loans and that we're being extremely intelligent and thoughtful on it. We want to grow loans again, something really important. And I do think we need to make sure that we're checking our pricing more and more frequently. We want to make sure that we're looking at our pricing on a daily basis, if not a weekly basis at most. Want to make, or at least, excuse me, want to make sure we're thinking about that and we're looking at what's happening in the world. Now, I don't want to compete with stupid. I don't want to just compete with someone because they have low rates, but I want to make sure that we understand where our competition is and why. Something really important. So one of the things I'm super excited about here is in our MFA Navigator, our client web application, as we used to call it, but our MFA Navigator, we have a new tab. And all of you out there, clients, can get in and play with this today. It's a loan pricing and loan buildup analysis. We're bringing in all of your loan types from ALM or CECL, and we're then putting in there some data and giving you the capacity to fill in some data to use this to help display to the rest of your management team how we should price loans. And if we think about this, our incremental borrowing cost today is roughly 5.25. Depending on where you're borrowing from, it's about the middle of the road. We add in a servicing cost, a CECL reserve, and hey, I want a minimum of 1% ROA. And then that gives me my neutral rate, my market rate of roughly 7.5%. Then on top of that, are we in a spot where there's lots of people looking for loans or not many people looking for loans? And one of the things today is liquidity is a premium. It's hard to sell loans. And so therefore we can actually get a little additional return. I added 1% here. That to me means a basic loan rate to keep growth in check, to still grow, not grow crazy amounts, is 8.5%. So please go into the Navigator, spend some time with it. It's a really great process for you to talk and be able to get in front of your management teams to talk about the importance of where loan rates are. Things have changed so quickly, it's very difficult for everyone to see this as best that they should. Now, at the same point here, a lot of things happening with deposits. We need to make sure we're pricing them correctly. One of the things that's been a difficult conversation, I know a number of you have heard this when we did our year-end economic update, we talked about deposit growth of -5 to 9% for 2024. It is going to continue to be an extremely difficult year to grow deposits. Why is that? Well, number one, we have our quantitative tightening going on. The Fed's pulling money out of the market. Number two, we have inflation. Lots of inflation on food and different things. Fortunately, gas prices are low right now. If those come back up, that's one of the things that does scare me. But food is going out quickly and very expensive. What else do we know? Well, if you've bought anything recently, a car, a house, anything, much, much bigger payments. So it's definitely a difficult time for people to have the savings. And on top of it, a lot of the government savings has gone away. And then also money market accounts at brokerage firms are paying really, really good rates. And so that's where people are going to be potentially moving some money over to their brokerage account rates. So with that, there's some market reality today. We're seeing savings rates in the 3% range, money market rates in the 4% range, 6-month CDs, 5 and even 5.5 for 1-year CDs. These rates change every day. They change for every location, every part of the country, but really making sure you understand what it takes to be competitive to others. And I want to be careful. I don't want to raise our internal cost of funds. I don't just want to do across the board rate change, but I need to make sure I understand where I can bring new money in and maybe from a tiering system where I need to be. So really important to think through this. It is going to be hand-to-hand combat on deposit growth. So with that, capital has been under all sorts of pressure this last couple of years. We dealt with OCI. We all know the OCI, unrealized gain loss securities, skyrocketed. It's come back down quite a bit as yields have come down across the board in treasuries. We had to deal with CECL, the implementation of CECL, the capital hit, the modification of CECL. We had to deal with that. And then we also dealt with asset growth. The substantial asset growth that we had really hit our capital ratios. So we came in here with a lower than perfect capital ratio. And again, lots of unrealized losses in the OCI area. Now what we're running into is we're beginning to see delinquency increase. If we think about it, we go through the process. We have liquidity issues, earnings issues, and credit issues, and now we're in the credit issue phase starting to come in. We are seeing car loans delinquent. We're seeing student loans delinquent, although that's a complete debacle how that whole student loan repaying process has gone. but we are beginning to see increased delinquency. This is something that's going to start to cause pain across the board for everyone and will result in higher CECL numbers. Also, as unemployment potentially comes up a little bit, maybe not a lot of CECL numbers are based off of unemployment, so we'll see that modification there. So thinking about this, I'm a big fan of never wasting a good crisis. And what I mean by this is you can use all of the uncertainty, all of the change, all the actions happening. You can use all that to actually come around and say to your coworkers, your team members, your board, we need to change this process. Let's use this crisis as leverage to say, hey, we have to reset loan rates on a daily basis, a weekly basis, not a monthly or quarterly basis. We need to change our deposit setting to a daily or weekly basis. We need to look at them and make sure that we're being proactive and maybe change tiers on a monthly basis to make sure that we've got it tiered right to keep the most deposits. At the same point as that marketing message, I want to make sure that we continue to have a really good marketing message at all times that's relevant to where we are in this world and make sure that we keep pushing on the marketing message correctly. So super, super important, but that marketing message is going to continue to be more and more important as we go into the next phase of the world that we're in. Again, we've been through the liquidity problem. We are through the we're in the earnings struggle right now and credit problems, and that's where we're going. Not in a bad way, not calling the end of the world, but we need to be prepared for that with making our changes and our discussing and putting our messaging out to our customers and members. So with that, things continue to change in other areas. And change is good, change is difficult. I know change is tough. It's especially hard when it changes on me. It's easy for me to say other people to change. Loan market participants is changing very quickly. We've got automotive captives back in the market. We've got fintech, they're all in. Fintech is all over the place. Every day I hear of a new fintech, which is really just some sort of loan aggregator. But one of the problems we're seeing today is there's more sellers than buyers. A lot more people looking to sell loans than to buy loans today, which is causing the market of loan transactions to be more expensive. So one of the things when looking at pricing loans, you ought to keep an eye on that market, making sure we're paying attention to it. But also remember that you might see your volume change because participants that left have come back in. And that's okay. We don't have to drop rates to keep our volume the same level. We should stick with our program and put loans on the books at the rates that are appropriate to us. On the deposit side, the market participants have changed substantially. Schwab was at 1 basis point forever with their money market accounts. Now if you ask nicely, you can go get in the 5.25% one or 5.20 yielding one, not the 2 or 3% one. There's a lot of competition for these high yielding money market accounts. So super important. With that, brokerage firms are back in the process and they're working really, really hard and making their best to gather assets because they can make a big spread, or at least make a spread when people are putting them in money market accounts. So that is taking place again. So we have this new competition. We've got to be prepared for it and work at it and push through and make sure we're having discussions talking about them. So with that, I want to hop over and talk about data to help us make better decisions. All right. So the top of everyone's mind every day is inflation. This is all over the news. Is inflation dead? Is it gone? Is it here? Where do we stand? What are the components of inflation? The short version of this is inflation is still too high, but it's coming down quickly. The PCE, Personal Consumption Expenditure Core Index, is at a 316 right here. I'm sorry, I got to put my pointer on so you can see it. Is right here. So we are coming down substantially. We were over 5.5%. The same point, the Consumer Price Index, all items, made it all the way up to 9. And we're back down here to about 3.1. X food and energy, it was up and back down. What we want to do is continue to see these numbers improve, as we want to see inflation get back to 2%. So we're heading in the right direction with a lot of the numbers. One of the things that is tough, though, as we look at this, all items is still pretty high. And food, which is the next one here, is all pretty high. All items less food and energy is up at 4%, higher than what the Fed wants. The saving grace right now with inflation is energy prices. We've seen gas down to $2.70 a gallon, $2.60 a gallon in a lot of places, except for California, to all of our California friends out there, but the rest of the country is seeing some very inexpensive gas prices. If that changes, that does make me a little bit nervous that inflation will come in hotter. But this right here is 12-month percentage change of November 2023. So some pretty big changes, still running higher than what we want. To look at this in a different way, I do really like this graph. Basically what this shows is all items, food, energy, everything included is here, but we had that big run up in gas prices and then we've come down quite a bit. And so this is the big outlier, again, energy prices. If energy prices turn around, we see demand, we see more conflict in the Middle East, that could potentially cause us to have an increased cost of energy prices, which would then have a negative impact. Which could have a negative impact to the inflation numbers and have them higher than what we want. It's not what we want, it's not what we expect, but that is one of the things that makes me nervous. So a big thing we talked about a couple minutes ago is delinquency and charge-offs. This is something we want to keep a close eye on because with CECL today, we have to remember that CECL is forward-looking, not rear-view mirror looking like ALLL. And so CECL looks at the unemployment rate, looks at other metrics, and says, hey, are my losses growing and is unemployment going up? Then I need to start reserving more in advance of me getting hit with those losses. And so CECL is predictive when run appropriately. So looking at delinquency, it's really important. Now here we have student loans, black dotted line. This is inaccurate. Somewhere around 30% of all student loans are delinquent right now, although we're in this phase-in period, so they're technically not delinquent, but they're considered not making payments. It's a mess. So we're just going to ignore the student loan piece. Credit cards, if we look back, all through we've been between 2 and 3.5%, and we got all the way down to 2. We got sub 2 here in 2021. Now we're back up to 2.98 or 3%. So we're back to normal levels. So something important to see there. We're still seeing auto loans bouncing around. They've come back down from their peak here recently in 2020 and 2021. So we're not seeing too much change here, but when we start to get a little bit more granular, we need to look a little bit deeper. The top chart here is delinquency rate in credit cards, all commercial banks. The gray area is recessions. We're down from the peak of the recession, but we've now recovered from the super low levels, and we haven't been at this level of credit card delinquency since 2012. So we're 11 years back. We've been lower levels. So we're back here. We'll see how it continues to go up, but this is an indicator that we should be expecting higher losses over the next couple of years. At the same time, there's a lot of writing about subprime auto loan delinquency. Subprime auto loan delinquency is up substantially. We're down for a while in the 3s, 4s, and now we're up in the highest level since 1996, running at about 6%. So, subprime's always a little high. We should expect that, but it's definitely higher than where it's been in a long time. So that should give us an indication that our CECL numbers will be going up, not down. And so we need to be prepared for a little bit tougher earnings, and we need to make sure that we're prepared to work on collection activities. So now, taking a step back and thinking about the other side of the balance sheet again, our deposit side, I do think this is going to be the toughest area that we're all going to have to work on this next year. And it is definitely going to be a different spot. And as we think about what's happening, we've really got to go back to what the Fed has been doing and talk about money supply. So here's M2 money supply, and we're going back to 1980. And we've always seen it come up. There's a couple little dips like right here in recessions, but we've never had a big reduction. Here we were kind of flat for a few years. Obviously, here's the pandemic growth, massive growth in the pandemic. We got highest point, and then since then we've had the quantitative tightening and money coming out. So this is the first time we've been negative. And if you look at this is just very unusual. What we see here, though, is if we start to put on a trend line, we're not too far off where we should be from a trend line standpoint. We're getting back to roughly the same spot. So we've got to basically go through 5 years. And this all started in 2020. So somewhere around 2025, I expect we're going to be back into a relative normal spot with money supply, which again, when money supply normalizes, that will help us normalize deposits. And to see where this comes through, now this is the entire banking system. Really important to understand the data we're looking at. But again, if we look here, the entire banking system deposits from 2013 through this last quarter, and we then run an annualized number, you can then see, well, we did come up a huge dollar amount with all the money. And again, look here, starting around 2020, right? All the money that came in from the government programs. It peaked here, end of 2021 into 2022, and we've been coming down. And so what that's doing is resulting in us almost being back to a neutral spot. I expect we maybe have another 2 quarters or 3 quarters of deposit reduction, and then that would get us back to basically our neutral amount where we have all of the pandemic money out of the system. So something is going to continue here. It's going to continue to be difficult. And one of the reasons why it's going to be continued difficult is the savings rate is not looking good. It's not terrible, the savings rate, but it's not looking good. And so as we think about where we are, this chart goes back to 1998. We were running in the 5, 6, 7% range. And, besides a couple dips down, where you can see kind of pre-recession, people were spending a lot of money and not saving. Then we had the recession to reset it. And then we got in this 5, 6, 7% savings rate again. And then the stimulus money, again, skyrocketed, huge savings growth. All these dollars came in. And what that resulted in then is this money then going out. So we haven't seen it all go out, but we've gotten back down to suboptimal savings rates because of the situation. So thinking about that, as consumers spend, as they go through any pent-up savings, we then should get back to more of a normal market. Now, to share this, this chart, it's a little bit dated. It's a year old, but it's really interesting to me as we look at during recessions, what happens to retail sales. Retail sales are coming down. Consumer price index is going up. So that results in more and more spending. And we're spending more than prices have gone up. We are seeing this start to come down, and this is where we expect to see the consumer spend a little bit less going forward. And then again, you look at the stimulus checks, the massive amounts of savings that came around here, and then we continue to go down. And so that's where, again, spending is coming out. People are spending it on retail sales, and that's going to continue until the consumer runs out of money. And that's where we're seeing credit card balances grow. So right now we're hitting record high credit card balances, huge utilization of credit lines, which means people are now going to have to really slow their spending, which means we'll have this slowdown continuing into 2024. A lot of people are calling it a soft landing. I pray and hope for a soft landing. That's what we're stating. But this will either be the result of the spending and savings and balancing out will either give us a soft landing or it will not. And this is another chart that comes along the lines with this is real disposable income. And we had these boring charts going back from 2006 to 2020, up, down a little bit. People were getting some positive earnings and their disposable income was going up a little bit. We skyrocketed with all the pandemic funds. It fell apart when the pandemic funds went away because our income went down because it went up. Now we've normalized again here with some pay increases and what's happening in the world. But this disposable income number is something that's not going to be growing nearly as fast as consumer spending has grown in the past, which results in a little slower economic activity. With that, we continue to see good, strong numbers with gross domestic product. We continue to see the economy going well. One of the difficult things is we're at a record level of bankruptcies in the country right now. So we have this high level of bankruptcies, but also high consumer gross domestic product. So again, a bit of a conflicting data point, but we've definitely normalized here after these massive swings with the pandemic shutdown and then the pandemic refueling with cash. So the next thing here that comes along this path is employment and employment participation. And this is something that's been a little befuddling to most economists. And why is that? Well, we've had some long-term structural things that have been a fight happening. If we look at this, our unemployment rate since 2010 has been consistently going down. We have our pandemic bump up and rehire. But if you look at this and we take out the pandemic moment, we've hit this floor here around 4%, 4.3%, 3.7 nationally. And we've been in this path coming down since 2010. What is interesting, though, is the weeks unemployed continues to stay higher than we would expect. We'd expect with this really low unemployment rate, the weeks unemployed would continue to shrink as demand is there. So there may be some structural unemployment where people are choosing not to work. But definitely that is a bit of a concern that it continues to be so high. We are beginning to hear about some people struggling to get jobs out of college. I don't know how true those data points are, but it is a different labor market. That's one of the things to think about with this different labor market is we've seen a significant change of what's happened with our labor force participation rate. And if we look at our labor force participation rate, back in 1965, we were around 59%. And we grew, and these gray lines are recessions. Again, looking back at all the different recessions. We continue to grow. We hit 63%, we're going to call it, in about 1978. And then we continued. Now, some of the things that happen here is we think about baby boomers and the number of people working and the activities, and we got all sorts of people working. A lot of dual income households came into fruition, and we ended up with 67% of the population working. Then we started this downward trend. And again, part of this is the aging population of the country. We should expect this to happen. We then hit the financial recession, which caused a lot of people to just retire early. And we got down to the 63% level, which is roughly where we are today, pre-pandemic. So we were already struggling with this low utilization. And to put this into relative nature, we haven't been at this level of utilization, labor force participation rate, since 1978. We're at the same percentage of people working. So we've got a lot of things happening, a lot of forces here, aging population, baby boomers retiring, millennials not quite old enough, big enough coming through out of the college yet. And we have this low. Gen X is not big enough is one of the big things I hear from a lot of demographers. But we've recovered now. We can see we've recovered here. People from the pandemic world are back to work. But we're at a spot that's going to continue to be a very difficult labor force participation, really difficult position to get a higher level of unemployment. So if remember, the Federal Reserve has a dual mandate, price stability and full employment. Well, they've kept full employment. Everyone that wants to work is working. If we go back to this chart, 3.7% unemployment, that's a wonderfully low unemployment rate. Then the second of their dual mandate is price stability. And we started that off with the inflation conversation today. So gauging what the Fed's going to do, a lot of it's based off that dual mandate of price stability and full employment. So before we get into the Fed and predictions of interest rates, one of the things to remember here is looking at the housing market. And the housing market is definitely an interesting spot here today. And I've got some interesting comments, which will come through, but I want to give some data first before I get into the comments. First thing, this chart looking at new and used home sales. New home sales continue to struggle. We've been talking about this for a while. The blue line is new home sales. We're down to 4 million. If we go back, we haven't been at this 4 million rate since the financial recession, the Great Recession. Why is that? Well, people back here couldn't buy houses. People here today can't afford to sell their houses because their mortgage rates would be so much higher in a new purchase. We look at new home sales. They never really recovered substantially. We were below 400,000. Got to remember, pre-financial crisis, we were close to 1.5 million new homes built a year, 1.5 million new homes built a year. We've never fully recovered in home building. We've gotten a bit higher here, but we also ran into inflation and labor shortages, which has really pushed down the new home sales. So it's running off the left-hand side around 700,000. Or here, the right-hand side is existing home sales. So what does that mean? Well, that means that this housing market is going to continue to be difficult for quite some time. Now, what really is confounding to a lot of people, and I'll add me to this boat, If we look here, this blue line is the 30-year mortgage rate. And what we would expect to see is with the 30-year mortgage rate going up right here substantially, we would expect to see that home values would come down. And we saw it a little bit, but then it turned around. So we're definitely seeing what is not expected, which is housing values continue to stay strong, even in the face of substantially higher mortgage rates. So what's causing this? What's the background piece of this puzzle? This is something that's going to affect all of us for quite some time here. And if you really think about this, low cost homes, I bought a home for $100,000 and I have a 3% mortgage rate. I have low desire to sell. I actually have an inability to move because that same house that I bought for $100,000 is now costing $200,000. And instead of a 3% mortgage, I'm at a 7% mortgage. So not only is my payment, because of my interest rates doubled, my payment doubles again because of the dollar amount more that I need to borrow. And so it's a substantial cost to move right now. Maybe if you put equity down, it's not as bad, but it's a substantial higher cost to move and move to a new spot. So a lot of people are effectively locked into their homes. Talk to a lot of people that in older years that you'd expect would downsize. They don't have the capacity to downsize right now because they can't. They can't downsize because they can't afford taxes on a new place. They can't afford mortgages on a new house. And it's an interesting issue out there. We don't talk about this a lot, but the taxes are based off the value of a home. Our municipalities have had massive pay increases. At some point, people are going to start talking about how home taxes are unaffordable at current rates. The other thing here, we'll talk about inflation. We've got a big issue with insurance right now. Cost of insurance is skyrocketing. The same point, if you think about this, high costs and high mortgage rates, higher taxes, high cost of ownership. You end up with two classes of people, those that have locked in homes at low prices and low interest rates, and those that are locking in homes at high prices and high interest rates. That cost of ownership is definitely going to modify and cause a lot of disparity between someone that owns a home today versus someone who's looking to buy a home today. And this is something that's hitting a lot of people, hitting especially a lot of millennials graduating from college, going out to buy a house. It's a tough, tough spot for millennials to go out and buy houses. So going to the bottom point here, inflation. This is something I think is going to be ahead of news cycles and something I do want everyone to take away from this. We are seeing significant issues with insurance rates on cars, significant issues insurance rates on homes. And what we're seeing here is forced place policy utilization is skyrocketing, especially in the South and the West. We're seeing insurance carriers exit markets very quickly. And we're seeing the cost of homeowners insurance up 40 to 50%. We're also seeing car insurance rates go up 40 to 50%. So something to be thinking about this year is how do we help our customers, our members with insurance issues, with getting insurance, which of course we need insurance to cover our collateral. Something that's definitely going to come to a head. We need some improvements. We need some changes. One of the things we are going to see is people leaving their homes. There's great stories about people in southern Florida selling their homes because they can't afford the insurance right now. They can't afford insurance at all, let alone the taxes as the taxes continue to reset up. There's also a lot of insurance reform out there. Needs to be a lot of reform on how insurance companies get sued, how they pay for damages. Different states are causing insurance companies to leave. And so something to be very notice or very careful about. We're going to continue to see this as an issue, I believe, for the next several years. So this is definitely going to put a pause on the market. It's going to cause less sales to take place. It's going to keep prices high. Is supply and demand is not going the right way for those looking to buy. It's a great way if you're looking to sell. The hard part then is buying that new home is going to be very, very difficult. So from here, talking about what's happening with the yield curve, the Fed, and going into the next set of projections. Well, we all know what the Treasury yield curve looks like today. It's getting flatter. Craig thinks it's not a beautiful yield curve. It's close to the flat Stanley yield curve here. Basically everything out a year on is in the 4% range. When we get short term, we're up in the 530 range. That's because Fed funds is at 5.25 or 5.5, excuse me. Um, this is back where we were in December of 12. Nice, pretty yield curve, but super low. Look at the differences here. If you look at the 10-year Treasury difference, it's 234 basis points higher, which is where your mortgage rates are higher. So the market today is saying, hey, we don't need to pay a higher rate for longer term because the market is expecting the short-term yields to come down and revert back to a positive sloped yield curve. So that's what the market is telling us today. If we think about where the Fed has been in the process we've been through here, the Fed raised rates, Federal Reserve raised rates going back in 2016, 17, and we got up to 19, 20 where the Fed stopped, and they were raising rates here because the economy was going well. They stopped, world started getting sick, things weren't right, and then boom, pandemic hit, we go down to 25 basis points. Stayed there a long time, and then the march up to where we are today, the very, very fast increase of rates with all the inflation that took place. So where we are today, how much longer are we here becomes to be the interesting question. Well, if we look at what the Fed funds futures say, today, the Fed funds futures are telling us it's a 50% chance that the Fed cuts rates here in March of 24. So 2 months out. January of 24, everyone's saying that we're going to stay unchanged right where we are. It's 50-50 for March, and then we get into about an 80% chance of a cut in May. So the market, and this is the betting in the market, is predicting a pretty quick march down of rates where we're around 4.25 by December of this year. So 100 to 125 basis points. The calls are all over the place. There are some economists saying 0 rate cut. There's some people even saying a rate increase, but there's a whole bunch of firms out there saying anywhere from 1 to 2.5% decrease of the Fed funds rate over the next year. So it all depends on your view of the outcome of the economy. We do think that rates are coming down. The speed that they come down is subject to be seen. But if we think about this in a big picture, the Fed is following their typical cycle. If we look back to 2005, 6, 7, 8, 9, what happened? The Fed was raising rates to break the housing market. They broke the housing market. They stayed here. They realized they went up too far and they stayed too long, dropped rates like a rock, became a really bad recession, and we kept rates low for a long time. We started raising rates again, and you see the 10-year treasuries on this downward slope. A pandemic hit, we dropped rates. This was the quantitative easing. The Federal Reserve did all sorts of quantitative easing, driving the 10-year treasury yield down. And now we've skyrocketed back up immensely with the inflation and trying to stop inflation. So now one has to start to ask the questions. Did the Fed go too far? Did they do this too quickly? Should they cut rates now or should they wait another year or two to cut rates? We're right here. Question is, are we here or are we back a little bit here and we still have some more time? The Fed has this boom bust cycle they've done historically. We all think they overdid it in the way up. Hopefully at this point, it didn't overdo it too much and we tend to come down on a slow basis. One of the things that makes me nervous is if the Fed does drop rates very quickly, that will hurt us from an earnings standpoint. I really want to make sure that today you're working with your investment advisor here at McQueen Financial to lock in yields for a longer term. Look at buying non-amortizing investments. Look at buying non-callable investments, buying investments that will really stick around for a period of time. Because if the Fed does drop rates like they did back in 2008, 9, 10, we're going to see our yield on assets come down very quickly. And there's always a delay for our cost of funds coming down. So we want to be prepared for change of interest rates. So with that, taking a step back to talk about leadership. Leadership is difficult. It's extremely rewarding, but it's also extremely difficult. And we have to make tough decisions without all the facts. We don't know exactly where rates are going this next year. The bet is that they're going to be the same to lower, maybe 50, 100 basis points lower. That'd be the direction. We'd also have to believe that the Fed is still going to have to make sure that inflation comes down, and they're going to be careful with that. And there's also the likelihood of that unemployment comes up because of the Fed taking care of inflation. And so with that, we are going to continue to see higher delinquency. And that higher delinquency number is something we're going to have to deal with, which is going to hurt our earnings from CECL. So making sure that we're doing a number of things, getting good growth. I have loan growth here, limiting loan growth, limiting unprofitable loan growth, focusing on profitable loan growth, making sure we're putting good loans in the books. Make sure that we're pricing correctly. Make sure that we're going after deposits appropriately in your market. Making sure we're preserving our liquidity by getting as many deposits as we can and making sure that we have good lines of credit. Really important that we do all those things today. As we look at where we are today and where we're going, there's a lot of uncertainty, but what we do know is as long as we continue to focus on our margin, make good loans, bring in good deposits, and consistently have a reasonable duration, not make big bets on long durations, not make on liabilities, deposits, borrowings, or loans, and we keep a consistent, reasonable deposits, we're going to continue to do well with a margin going up and down at all times. That's what we need to do. So as we go forward, change is going to be very difficult. We've got wars happening. We've got uncertainties. We have ships being attacked. We have political infighting. We have, political instability with parties attacking each other in different ways. Lots of disinformation. So we think about all these changes out there. Sometimes the best thing to do is to take a step back from the noise and focus on what we know and what we're good at and continue to do that. Making good quality loans at good rates and taking good deposits and focusing on that margin. I do expect 2024 to be a year of tougher earnings, potential asset reductions, potential deposit runoffs, and that is okay. For us to have reduction for a couple years is not a problem. I am a big believer of grow or die, so we want to always grow, but it's okay if we look at that over a 5-year time frame, 6-year time frame. We had massive growth the last 5 years. Now it's okay that we don't grow for a couple years because the market's not growing. Then from there, we'll have to return to our growth strategy. Today, it's continue to focus on what we're good at, continue to be good at what we do, and then continue to focus on the right things on a go-forward basis. So with that, all of us here at McQueen Financial are here to help you make difficult decisions, here to help you make rewarding decisions. But one of the things I do want to leave you with is make sure that you continue to make decisions and don't get locked in paralysis, because in the end, it's not a good thing. Making a decision that may be wrong or needs to be modified is okay. Make that decision and then continue to roll forward. So with that, I'm really excited and that you all are able to spend the time with me. I appreciate everyone being on this call. All of our advisors here are here and ready to help you through this interesting year we're going to be hitting here. And with that, I'm excited that our next webinar coming up is really on the charitable side of things, something extremely important to all of us here. I know we all have our favorite charities that we give to and care about and organizations. And we've had a lot of fun helping a number of our clients set up foundations and manage the money in the foundations. In the credit union space, the CDA accounts, and also foundation management, the banking space, foundation management, community foundation, investment management. Really appreciate everyone that we work with in that area. I'd love to give a little shout out to Craig Cecilia and Zach Whaley, doing an amazing job in our investment management. And also Matt, want to thank you for our foundation work that you're doing there. But a wonderful, wonderful group of people, our team working in different areas here. We're going to have a presentation on how to set up a foundation and manage the money in a foundation. As we have a lot of clients asking us about that they want to help out their individual communities. So it is coming up February 28th, 2 to 3 p.m. Love to have you join. With that, thank you all. Appreciate you spending some quality time with me. Everyone have a wonderful rest of your day. Stay warm. Have a wonderful afternoon. Thank you.